Well, Janet, I love in your research note how you talk about bonds fully priced. What do? You have a history of dealing with high net worth within the sophistication of your LSE economics. What do you do when it's price up and yield down this much?
Well, what we see is there's just extreme volatility and uncertainty in the market. And so we think this kind of move is probably unjustified. And after the move, literally, we think the bonds have become even pricier. And that's why we are not keen to add any bond duration despite the uncertainty. And what we prefer, I mean, as a hedge to all this uncertainty, is to add gold or defensive income streams such as infrastructure.
Interesting. Jordan Rochester, one of the things, this came up in a conversation I had yesterday on 1987. Do you maintain fixed income and hedge against it to protect your gains? Or are you more activist, more unhedged, and do something different in bonds?
Well, Tom, we live in a crazy world. With all the negative yields, we now live in a world where you buy bonds not for yields, but for capital appreciation. And if you want yield, you've actually got to go for equities. So it is a bit bonkers, as you're all saying. Now, Tom, when it comes to hedging this, it's really difficult because bonds are your hedge. Risk off, you buy bonds. Foreign exchange intervention, you buy bonds. Trade tensions, you buy bonds. So it's all leading up to this. And then you add on top of that ECB, the Fed, cutting rates, you buy bonds. So it's a real big consensus position. You've got trend followers, active managers, everything in it. So there is a risk that there is a sort of VAR spike. If a sell-off starts, it becomes a bit of a cycle.
Yeah.
You could see that on the day the ECB does its package. So when the ECB eases, typically they under-deliver, and you have a one-day move where bonds sell off and the euro goes higher. Right. But I think, Tom, we're going into a global slowdown. Recession risks are real. You need to own fixed income, unfortunately.
I mean, Nara, to this point of these two good guests, I'm absolutely fascinated about derivative strategies into September. I mean, I don't understand how you hedge, given that panel we just put up of 2-year, 10-year, 30-year. I mean, I don't understand how derivatives work in the space we're in.
I'm not sure I can enlighten you on that, Tom, but I do want to pick up on what Jordan was just saying about the fact that you kind of need to own bonds when there's this much momentum. And Janet, I want to pick up on that because you said you don't necessarily want to hold duration. You'd rather hold gold at this point. But if the trade is sort of going one way and there's the capital appreciation perspective, maybe there is some value there. So let me ask you, under what circumstances, if any, might you consider holding 50 and 100-year US bonds that Stephen Mnuchin told Bloomberg they might be considering issuing the Treasury?
I think in the US, there's more of a case of owning bonds because after all, you're still having some decent yield. I mean, I think if we see, structurally much slower economic growth, much lower inflation, then there will be an incentive to own this ultra-long bonds. Yeah.
I know you gave sort of the reasoning of why we've seen the yields drop, Jordan, but are they actually reflecting the economic reality in terms of your view of how quickly or how soon we're heading for recession?
I mean, we don't think a recession this year, but it's on the cards for next year if this slowdown globally and the trade wars and everything else continues. Like I said on the previous question, it's hard to be short fixed income here. You're right, it's going to a place where it seems unreasonable, but I think anyone who, if we talk about 50-year, 100-year bonds, I think anyone who sold the Austrian 100-year bond over 6 months ago would really regret that decision. So you have to be very careful with what you do about this.